Let's bring in Kevin Mahn, the President and Chief Investment Officer at Hennion Walsh Asset Management. Okay, so the Fed needs to cut.
Yes.
You're not the only one who believes that. But take us through why it has to do it soon or not.
Sure. And let's just remember back to last year when the Mag 7 accounted for 62% of the total return of the S&P 500. Thus far this year, 44% of the return of the S&P 500. Take out Tesla, and it's nearly half of the return of the stock market. So they're still dominating, but the breadth is starting to expand. For that breadth to expand further, we do need the Fed to start cutting interest rates. For the Fed to start cutting interest rates, though, we need, Dom, at least 2 consecutive quarters of a slowing economy, provided that inflation continues to moderate. That takes us all the way out to July at the earliest. So for those market participants that are hoping for a Fed rate cut sooner than that, think again.
But then if they don't cut,
yeah,
is it safer to sit and wait rather than make any changes, I guess, one way or the other? What's the bigger risk, I guess, cutting too early or waiting and seeing?
It's a great question. We look back to the 1970s as the blueprint for what could go wrong. The Fed cut interest rates back then prior to inflation coming to 2%. And what did that bring on? Double-digit levels of inflation. Paul Volcker stepped in, raised interest rates to a high of 20%. And what did that bring on? A recession. So they're really trying to thread the needle here. The bigger risk is that they keep rates too high for too long and push the economy into a recession.
If you're an investor, to your point, I guess the Mag 7 have pulled back a little bit for what they're contributing, but still, without Tesla, would you say about half, 50%? So you can't really afford to not have a significant position in them, can you?
And I think they will move higher, and they'll drive the U.S. economy ahead. Certainly names like Microsoft will be the ultimate winner of the AI race, in my opinion. Names like Amazon, who continue to dominate the e-commerce space. And NVIDIA, how can you bet against NVIDIA at this point in time, especially with the expectation that they're going to deliver their next generation chip later this year? But there are opportunities beyond just AI. Consider cybersecurity. How about aerospace and defense, or even some consumer staples and discretionary names? There are other opportunities out there, but for them to really take off, we need the Fed to cut.
All right, so let's talk about why they have to cut in the guise of the market.
Yes.
They don't have to right now, despite today's market action. They haven't really done anything. Expectations have pretty much gone away for as many cuts as we saw 3 months ago, 6 months ago, and yet the market still hovers near record highs. People still get paid 4 to 5% on cash balances, yet they still buy stocks as well.
Correct.
It seems like everything is going up in value at the same time that the opportunity cost of giving up cash is still relatively high. What gives?
I believe that the Federal Reserve wants to start cutting interest rates sooner than later. Why would they be forecasting 3 interest rate cuts of 25 basis points this year if by their own forecast inflation will only come down to 2.4% by the end of this year? I think they're more concerned with inflation staying below 2%, remember where we were just 3 years ago, than they are with inflation actually staying too high. They have difficulties reflating the U.S. economy. They're more concerned with keeping rates too high for too long and pushing us into a recessionary period. If the Fed does what they suggest they're going to do and cut interest rates by 250 basis points over the next 3 years, both stocks and bonds should move higher. But we are going to have to be more selective over the next 6 months when the economy will slow and when, in fact, there's going to be a pickup in volatility. The pullback we're seeing today, I'd expect more short-term volatility ahead.